Introduction. Key market factors.
Key things we're watching at Harvest over the past month. Earnings, breadth and momentum trump tariff and AI volatility. DeepFake or DeepSeek, shot across the bow that advocates diversity. Oh Canada or uh-oh, look at stocks, tariffs, and the Canadian dollar.
Earnings, breadth, and momentum.
Following back-to-back 20% returns over the past 2 years, the S&P 500 continued to produce strong returns since the start of 2025 and through early Feb. Kicking off the early earnings season in mid-January, U.S. banks particularly posted strong returns nearly across the board on strong and improving fundamental growth expectations. And generally, fourth quarter earnings season has produced strong returns through early mid-Feb. Similar to the market, our U.S. banks ETF, HUBL, continued the momentum from last year and was the best performing ETF in our HDIF, Diversified All-in-One Equity Income ETF. While tech did pull back, giving some relative strength from last year, our Tech Achievers, HTA, given its diversity, eked out some positive returns, and within our HDIF, all 9 of the ETFs managed to post positive returns. Notably, traditional defensive sectors like healthcare that lagged last year and HUTL, our global utilities ETFs, benefited from some of the diversity outside of Canada and strong performance from our European utilities. Earnings have not been uniformly strong, though. Performance post-earnings has been varied. Markets are sensitive to headline risks, and volatility signals are elevated.
The AI space. DeepSeek or DeepFake?
The technology sector was rattled in January by the release of the latest version of DeepSeek, a generative AI model developed by an AI-focused company based in China. Reports of the model's performance in comparison to some of the most advanced models developed by US-based companies were revolutionary in their own right, especially given US export restrictions into China for the most advanced processing technologies. However, the greater source of volatility for the tech stocks came from the release of the technical documentation. The model indicated a significantly reduced cost for developing compared to its US peers. Technology stocks that have benefited the most from spending on infrastructure to support the development, such as NVIDIA and Arista Networks, were the most significantly impacted by the volatility that ensued as investors have reevaluated their estimates of long-term investment in the most advanced hardware. In the days that followed, many experts began to question the validity of the claims of training an advanced model on cutting-edge hardware, as well as the cost estimates for the model's development. Although the sector has rebounded to some degree from the initial headlines, the event served to highlight the potential for elevated volatility in areas where high levels of investor concentration. As Chris Heeks on our team recently pointed out in an asset allocation insight piece, there's no free lunch other than diversification, and I would echo that as par for the course as we navigate and balance economic strength against meaningful tariff and particularly high political narrative tail risks.
Canada's economic landscape with politics and tariffs.
Between tariff talks and threats, muted and decelerating economic data, and nauseating domestic politics, Canadians are at a crossroads with many issues. Particularly the Bank of Canada is in a predicament on how much it can cut interest rates in a slowing economy in the face of potential tariffs and potential for imported inflation risks. Emotions are running very hot. So look, taking emotions out of it from an investment perspective, one, we have some great companies in Canada, many with oligopolistic-like characteristics that generate great dividends, and despite all the noise, they've done actually very well. Our HLIF, which is 30 dominant Canadian dividend leaders with a covered call strategy and high income, has actually outperformed the S&P 500 since last June. Second, the old saying, if you want to know what stocks are doing, ask the bond market. If you want to know what the bond market's doing, ask the currency market. And if you want to know what the currency market's going to do, you got to ask a higher market. Despite all the currency strategists depicting a demise of the Canadian dollar to $1.50 or $1.60 over the tariff weekend, the Canadian dollar has surprisingly strengthened to near the best levels of the year. It has declined over the past while on concerns that I highlighted earlier, but the currency markets are giving a bit of a signal. It's a great time to look at different options for Canadians on how to get exposure to US stocks and perhaps minimize some of the currency volatility.
Subscribe to Harvest ETFs Insights. Join us and stay informed.